Right now, as you're watching this, the same ounce of silver is trading at two completely different prices. In New York, paper silver just hit $72. In Shanghai, physical silver is trading at $100, the same metal. That's a $28 gap, a 39% difference between what paper says silver is worth and what people actually pay. This shouldn't be possible. In functioning markets, arbitrage closes gaps like this in minutes. Buy cheap in New York, sell expensive in Shanghai, pocket the difference, but it's not closing, it's holding. And in some moments over the past 48 hours, it's been widening. That tells you something is breaking. If you're just discovering this channel, I show you what's actually happening in global markets. Subscribe right now because this video will explain something you won't see on CNBC or Bloomberg. And if you find this valuable, smash that like button. It tells YouTube to show this to more people. Drop a comment right now with one word: physical or paper. Tell me which one you think wins this fight. Here's what this gap is telling us. When paper and physical diverge like this, one of them is lying. One of them is showing you a fake price. And I think I know which one. Let me show you what just happened in the last 72 hours because this is where it gets disturbing. On February 3rd, silver was trading above $90 on both exchanges. Then everything changed overnight. In a single morning session on the Shanghai Futures Exchange, 1.44 million contracts traded. That's 674 million ounces of paper silver in one morning. For context, global annual mine production is 800 million ounces. They traded almost an entire year's worth of mining output in a few hours. This wasn't normal selling. The price collapsed from $90 to $73 in 2 hours, a 22% free fall, the most violent intraday move in decades. And here's the part that should make you sit up straight. While paper silver was being destroyed in Shanghai, physical silver inventories at COMEX in New York were draining at a rate nobody has seen before. February 4th, 3 million ounces removed from COMEX vaults in a single day. Not traded on paper, physically removed, loaded onto trucks, gone. Nearly 2 million ounces pulled from Asahi, over 900,000 withdrawn from HSBC, another 282,000 from JP Morgan. Total COMEX silver inventory dropped to 400 million ounces. But here's the contradiction that breaks the entire narrative. While 3 million ounces drained from the vaults, over 3,500 futures contracts received delivery notices in the first 4 days of February. That's 17.5 million ounces, all accepted for physical delivery. Normally 1% to 3% of futures contracts settle in physical metal. Right now, we're seeing 100% physical settlement. You cannot build AI data centers with paper contracts. You cannot manufacture missiles with digital IOUs. The world is desperate for the real metal. And while that desperation is accelerating, the paper price just crashed 22% overnight. This is not normal market behavior. This is a war between two realities. Paper says silver is worth $72. Physical buyers are paying $100. Both cannot be right. The system is cracking under the pressure of that lie. Let me walk you through what I believe is actually happening here, because when you see the full picture, the $28 gap stops being confusing and starts being predictable. Someone is trying to destroy long positions before a specific deadline. And that deadline is March 27th, first notice day for March silver futures. Every trader holding a March contract must declare their intention by that date, cash settlement or physical delivery. Right now, March futures contracts represent 528 million ounces of promised silver. COMEX vaults hold 113 million ounces. Read those numbers again. 528 million promised, 113 million available. They promised almost 5 times more silver than actually exists in the warehouse system. If just 22% of contract holders demand physical delivery, the vault is completely empty. What happens when the 23rd% shows up asking for their silver? This is the nightmare scenario that exchanges are desperately trying to prevent. This is why we just saw coordinated margin hikes from CME in Chicago and Shanghai Gold Exchange in China on the same day. America and China disagree on almost everything: trade wars, sanctions, technology restrictions. But on silver margin requirements, they moved in perfect lockstep. Same day, same direction. Both raising margins to force traders out of long positions. That doesn't happen by accident. That happens when both exchanges are looking at the same terrifying number. 528 million ounces promised, 113 million available. And the solution they chose wasn't to find more silver. It was to destroy demand by making it too expensive to hold futures. In the last 9 weeks, there have been 9 margin hikes on silver futures. For comparison, in all of 2024, 2 hikes. In 2023, 3. In 2022, 2. 7 margin hikes across 3 years was normal. 9 hikes in 9 weeks is extermination. Here's how the margin hike weapon works, and why 9 hikes in 9 weeks is designed to kill you. When you trade futures, you put down a margin deposit, usually around 10% of the contract value. If you want to control $100,000 worth of silver, you deposit $10,000. That's your margin. Your skin in the game. When the exchange raises margin requirements, you suddenly need more cash. Not next week, not when your wire clears. Immediately. If you don't have it sitting in your account, your position gets liquidated automatically. One margin hike is survivable. Most traders keep a cash buffer. 2 or 3 hikes, you start feeling pressure. But 9 hikes in 9 weeks, each one draining more capital from your account, that's not risk management. That's a systematic campaign to force liquidation. And it worked. Each margin hike triggered forced selling. Forced selling pushed prices down. Lower prices triggered margin calls on other traders who weren't even affected. More forced selling. More price drops. A death spiral by design. That death spiral is what you watched over 72 hours. But here's what the margin hikes couldn't do. They couldn't stop physical demand. They couldn't change the fact that industrial users need real silver, not paper contracts. They couldn't make 113 million ounces turn into 528 million. They couldn't close the $28 gap between paper and physical. What this suggests is that the paper price is artificially suppressed, while the physical market is reflecting something closer to reality. And that reality is this: silver is far more scarce than the paper price indicates. Let me show you the evidence, because this isn't speculation. This is data you can verify. Shanghai silver spot price as of February 6th, $100 per ounce. COMEX silver spot price as of February 6th, $72 per ounce. That's a 39% premium for physical silver in China. Now, why would Chinese buyers, some of the most sophisticated traders, pay 39% more than they have to? They wouldn't. Unless they know something. Unless they know the $72 price is fake. Unless they know that physical silver at any price near $100 is still undervalued. Compared to what's coming, these are not retail investors panic buying. This is institutional money, manufacturers who need silver for production, sovereign wealth funds. These entities don't overpay by 39% unless the alternative is worse. And here's the smoking gun that tells you the $72 paper price is not reflecting reality. The gap is not closing. On February 3rd, the gap was $25. On February 4th, it hit $30. Today, February 6th, it's $28. Shanghai is not crashing with New York. Physical is holding while paper collapses. If this was a real crash, driven by actual supply and demand, both markets would move together. They're not. Paper is in freefall. Physical is holding steady. That tells you everything. One of these prices is a lie, and the market is figuring out which one. Now let me show you who benefits from that lie. Because when you follow the money, the picture becomes crystal clear. JP Morgan holds the largest silver short position of any bank in history, over a decade short. Every dollar silver drops, they make hundreds of millions. Bank of America, massive shorts. HSBC, massive shorts. These banks sit on CME committees. They have visibility into positioning. They know where the pressure points are. Friday, February 3rd, when silver crashed 22%, regular traders lost everything. These banks made billions. Today, as silver crashes through $72, they're making billions more. I'm not alleging crimes. Short selling is legal. Exchange committees are legal. I'm pointing out that the entities who profit most from this crash are the same entities, with the most influence over exchange policy. Draw your own conclusions. The timing of last week also matters. Thursday evening, Reuters published a story claiming U.S. government ending support for strategic metals. Anonymous sources. Algorithms triggered. Selling cascaded. 3 hours later, Energy Department statement, quote, the article is false, quote, and relies on sources that are misinformed or deliberately misleading, end quote, false, completely made up. But markets had already crashed. Algorithms don't reverse for corrections. Also Thursday night, Kevin Warsh Fed chair nomination leaked. Hawkish, bad for metals. Official announcement Friday morning. Insiders knew Thursday night. Fake news, leaked nominations, 9 margin hikes. All in the same window. Coincidence? And here's something I found this morning that nobody's reporting. The day before the crash, Thursday, there was unusual options activity on silver ETFs, massive put buying. Someone made huge bets that silver would collapse the day before it happened. Either someone got very lucky, or someone knew what was coming. Now, here's what happened to traders who tried to get out. They couldn't. In China, the UBS SDIC silver fund was halted. Not slowed down, not restricted, completely halted. Entire session. 0 trades executed. No buying, no selling, nothing. Imagine watching silver crash 30% and not being able to sell. Clicking the sell button and nothing happening. Refreshing the page, still nothing. Calling customer service, hold music. Watching your net worth evaporate minute by minute while the exit door is locked shut. That's what happened to thousands. In the US, ProShares Ultra Silver dropped 62%. If you had $100,000 Thursday night, you had $38,000 Friday evening. 62% of your money gone in a single session. iShares Silver Trust dropped 31%, worst day in the fund's entire history. But the price drops were not even the worst part. Traders tried to sell, orders rejected, platforms showing error messages, systems overloaded, customer service phone lines with wait times over 2 hours. And when you finally got through, they told you there was nothing they could do. One trader messaged me saying he tried to close his futures position. For 18 hours straight, every single order rejected, watching his account drain dollar by dollar, thousand by thousand, with absolutely no ability to stop it. As of last night, some traders still reporting account access issues. Days later, still unable to see their balances, still unable to execute trades, still locked out. They crashed the price, then they blocked the exits, then they raised margins again. Think about that sequence. Crash, lock, raise. If you were designing a system to destroy long positions, to transfer wealth from retail to institutions, this is exactly how you would build it. Now here's the fundamental picture that makes this crash even more insane. The crash makes no fundamental sense. None. Silver has been in supply deficit for 5 consecutive years. Solar needs it, EVs need it, AI chips need it, iPhones need it. Demand is exploding. Mine supply is flat. The cumulative shortfall since 2019 is 1.3 billion ounces. That's 18 months of global production consumed. Gone. And then China locked the door. January 1st, 2026, silver added to strategic materials list. Export licenses required. Volumes down 40%. China refines 65% of the world's silver. They just told the West to find another supplier. There is no other supplier. And it's not just traders getting hurt. This crash is destroying businesses worldwide. In India, in the jewelry trading hub of Rajkot, 44 firms have declared bankruptcy in the last week. $425 million in losses. Families who have been in the silver trade for generations wiped out in 72 hours. In London, 2 hedge funds have suspended redemptions. They cannot give investors their money back because their silver positions are underwater and they cannot sell. In Dubai, physical silver premiums spiked to 15% over spot. Dealers cannot get enough metal to meet demand. This crash is creating wreckage across the entire global financial system. And we're only a few days in. Now connect the dots. 5-year supply deficit, exploding demand, China restricting exports, and the price is crashing. That only makes sense if paper is being manipulated down before March delivery. I think physical wins. I think it always wins. Paper promises can be printed, metal cannot. But right now, paper's winning. Let me show you what's actually happening beneath the surface, because the vault data tells a story that contradicts everything you're seeing on the price charts. COMEX registered silver, the silver available for delivery, dropped from 430 million ounces 4 years ago to 113 million ounces today. That's a 74% decline. But the bleeding is accelerating, not slowing down. First week of January, 7 million ounces left. Third week of January, 33 million ounces walked out. Not traded, physically removed. That's 26% of everything they had in 1 week. Who is taking this silver? Not retail investors. Moving 33 million ounces requires trucks, security, warehouses. This is institutional money, smart money. They're draining the vault before March, and here's why March matters. This is critical. March futures represent 528 million ounces of promised delivery. That's how much silver has been promised to traders holding March contracts. The vault has 113 million. Read those numbers again. 528 million promised, 113 million available. They promised almost 5 times more silver than physically exists in the entire COMEX warehouse system. The first notice day is March 27th. That's when every trader holding a March contract must declare their intention, cash settlement or physical delivery. If just 22% of contract holders demand delivery, the vault is completely empty. Not tight, not stressed, empty. What happens when the 23% shows up asking for their silver? Now, this is the nightmare scenario that CME and Shanghai are desperately trying to avoid. This is why we're seeing coordinated margin hikes. They need to shake out longs before delivery demands expose the whole system, and it's working. Look at the price right now. Silver at $72. Longs are being exterminated. But here's the part that kept me awake last night. This morning, same day as the CME hike, Shanghai Gold Exchange also raised margins, 20% to 26%, same day. CME in Chicago, Shanghai in China, 14 time zones apart, same day, same action, same direction. America and China, these two agree on nothing. Trade war, sanctions, they argue at every international meeting. But on silver margins, suddenly they're moving in perfect lockstep. That is not supposed to happen, unless they are both scared of the same thing. And I think I know what they're scared of, 356 to 1. That's paper to physical silver on the COMEX. For every 1 ounce of real metal in the vault, 356 ounces exist on paper. 1 real ounce, 356 paper claims. This works when everyone settles in cash, but when people demand physical delivery, the math explodes, and people are demanding physical delivery. Lease rates tell you everything you need to know. Right now, silver lease rates are at 8% to 10%. Normal is 0.5%. This is what institutions pay to borrow physical silver. When lease rates spike like this, it means physical metal is hard to find. The last two times lease rates hit these levels were 1980 and 2011. Both times, something big happened shortly after. Someone is desperate for metal right now, desperate enough to pay 10% to borrow it. You don't pay 10% to borrow something that's about to get cheaper. You pay 10% because you need it now and you cannot find it anywhere. While lease rates scream shortage, the paper price just crashed 22%. That divergence is the story. Physical reality versus paper manipulation. And right now, manipulation is winning. But history says it doesn't win forever. At some point, paper has to reconcile with physical. It always does. Throughout history, every single time, physical reality wins. The only question is, how much damage happens first? How many traders get wiped out? How low does paper go before the manipulation breaks? I think physical wins. But here's what panicking retail misses. Crashes don't destroy wealth. They transfer it. Friday, wealth moved from retail to banks. When this reverses, it moves back. The question is which side you're on when it happens. Paper at $72, physical at $100. That gap closes eventually. Someone profits when it does. Here's what I'm watching. These are the numbers that will tell you what happens next. The Shanghai premium, currently $28. This is the truth teller. This is the gap between what paper says silver is worth and what physical buyers are actually paying. If this gap widens to $40, paper is losing all credibility. If it narrows because physical starts dropping, the manipulation thesis might be wrong. But if it narrows because paper rises to meet physical, that's when you know the game is changing. This gap tells you everything. COMEX vault levels. Every Friday, they release the data. Last week, 33 million ounces walked out. If this week another 20 or 30 million leaves, the vault will be nearly empty before March. Who is taking this metal? Where is it going? Why are institutions paying? For trucks and security to move physical silver while the price is crashing? They know something. Lease rates currently 8% to 10%. Normal is 0.5%. This is what institutions pay to borrow physical silver. When lease rates spike like this, it means physical metal is hard to find. You don't pay 10% to borrow something. That's about to get cheaper. You pay 10% because you need it now and you cannot find it anywhere. March open interest. How many contracts are still open for delivery? If traders are holding despite the pain, open interest stays elevated. High open interest going into first notice day means delivery pressure. That's what the exchanges are trying to avoid. And trading halts, platform freezes, account lockouts. If more funds get halted, if more platforms freeze, that tells you the system is under stress. Functioning markets don't freeze. Stressed markets do. Here's what I want you to understand about what you're watching right now. This crash is not random. It is not normal market behavior. 9 margin hikes in 9 weeks. Unprecedented. CME and Shanghai coordinating on the same day. Enemies moving together. A $28 gap between paper and physical. Divergence that should not exist in an efficient market. Vaults draining at 26% per week. Smart money running for physical. Traders locked out of accounts unable to exit. 44 firms bankrupt in India. Hedge funds freezing redemptions. Physical premiums spiking globally. This is not a correction. This is a coordinated attack on long positions designed to shake them out. Before March, delivery demands expose the fractional reserve nature of the COMEX. It is working. The attack is working. Longs are being destroyed right now. Silver at $72, but the fundamentals have not changed. The shortage is real. Physical is trading at $100, while paper trades at $72. At some point, this ends. Paper reconciles with physical. The question is whether you survive until that moment, whether you can hold through the pain, whether your stops got hit. That trader who messaged me, he didn't survive. He was right about everything and he still got destroyed. Think about what that means. Being right doesn't matter if you can't survive the manipulation. This is the lesson. Position sizing matters more than being right. Risk management matters more than conviction. Survival matters more than profit. Ask yourself tonight, do I understand my exposure? Is my position sized for survival, or am I one margin call away from losing everything? The winners in markets like this are not the ones who predict perfectly. They are the ones who survive, who manage risk, who stay calm while others panic. This is not financial advice. Your money, your decisions, your risk. Here's what happens next. Nobody can tell you exactly where the bottom is. Anyone claiming certainty is lying. What I can tell you is what to watch for. Shanghai premium is not collapsing with paper. Physical buyers still paying $100. If this was a real crash driven by fundamentals, physical would be crashing too. It's not. Physical is holding. Vault drain continues. Smart money is still taking physical delivery. While retail traders panic and sell, institutions are backing up trucks. The fundamentals have not changed. The deficit is still real. China is still restricting exports. Industrial demand is still growing. What has changed is the paper price. Only the paper price, pushed down through 9 margin hikes and cascading forced liquidation. At some point, paper has to reconcile with physical. It always does. Throughout history, physical reality wins. The only question is how much damage happens first. Gold at $4,500, silver at $72, Shanghai at $100. The gap is screaming. Paper and physical cannot stay this far apart forever. When it closes, someone will have bought at the bottom. Someone will have held through the pain. That could be you. Or you could be the trader who got margin called out. The difference is not luck. It is risk management. Drop your thoughts in the comments. Are you watching physical or paper? What do you think happens when March 27th arrives and delivery demands hit that 113 million ounce vault? Share this with someone who needs to see the full picture. Subscribe because I'm covering this daily until it breaks. We're watching a system transition in real time, from paper-driven price discovery to physical-driven price discovery. How long that transition takes, how violent it gets, that's still being written. But the direction is clear. The gap exists because one price is fake. The question is how long the fake price can hold before reality forces reconciliation.